Welcome to Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, markets looking to shake off back-to-back losses. Futures are pointing to gains at the open with tech stocks outperforming. The big moves we're watching are in oil. Crude sliding more than 4% as tensions with Iran appear to be de-escalating. Oil's now on track to snap a 5-day rally after President Trump said, quote, the killing in Iran is stopping. Plus, earnings season for the big banks wrapping up this morning. Morgan Stanley and Goldman Sachs both beating earnings expectations on the top and bottom lines. The results driven by the bread and butter businesses, deal making and trading, but the shares are down. We'll talk more about that. And the world's largest asset manager, BlackRock, getting even bigger. The company's assets under management hitting a new record above $14 trillion. Those shares up. And the biggest moves on Wall Street this morning driven by Taiwan Semiconductor. Those shares jumping as the contract chip maker crushed earnings expectations, posting another quarter of record earnings, a sign the AI boom isn't over yet. And that's driving action across equipment makers, suppliers, and other chip stocks. Let's take a closer look now at some of the earnings results rolling in today from Goldman Sachs and Morgan Stanley. As I mentioned, both of those stocks are trading lower. So what are some of my big picture sort of takeaways from these companies? For Goldman Sachs, they absolutely crushed it in terms of their equities trading revenue last year, $4.31 billion, which was not just the highest for Goldman Sachs in a quarter, it was for the highest for any bank ever. In terms of that equities trading revenue. So that's something that stood out there. Morgan Stanley made a lot of money in terms of its debt underwriting. It's been underwriting a lot of these deals, a lot of these financings for the various data centers. And so that's something that investors have been focusing on. Debt underwriting revenue surging by 93% to $785 million for that company. But to put this in context here, when you look at those two items and then the third, which is that both of the stocks are trading very close to record highs. In the case of Goldman Sachs, it closed at a record on January 6th. Actually, both of them closed at records on January 6th. And now we have Goldman Sachs, which is down a little more than 2% from those levels. Morgan Stanley down close to 4% from that record close. So even though those items I mentioned, they beat on those metrics, investment banking fees overall for Goldman Sachs were also strong. Remember, the company is selling off its Apple Card business to JP Morgan Chase, and so it had some one-time items related to that. All in all, the numbers for Goldman look good. But given that it is trading near that record, according to some analysts like Devin Ryan, who I'll be speaking to later this morning, maybe that setup is one of the reasons that we're seeing the stocks lower. Similarly, for Morgan Stanley, the numbers really beating on a number of those broad metrics. Investment banking revenue at Morgan Stanley up 47%. It posted record net income on an annual basis. And its wealth business, which investors watch closely, saw net new assets of $122 billion. Again, Devin Ryan over at Citizens, JMP Citizens, saying that was something that investors were focusing on. He said that the fact that Morgan Stanley is not raising its outlook for return on tangible common equity, that's an important metric for these companies, that might be a little bit of a source of disappointment. We're going to continue to dig into these and have much more on them at the top of the next hour. But let's broaden it out here because stocks are looking to open in the green after 2 straight days of losses. Chip stocks leading the move higher as those strong results from Taiwan Semiconductor restore some confidence in the AI trade. Joining me now, Venu Krishna, Barclays head of U.S. equity strategy. Venu, thank you so much for being here. Appreciate it. So we're looking at tech kind of coming back a little bit this morning, even as we've gotten into earnings season, and the bank's reaction has not been as positive. But there seems to be a lot of optimism still going into this earnings season.
There is, and I think we are in that camp. We do expect in aggregate earnings to be up double digits this year. And what's important to note is that's happening at a time when we are not necessarily benefiting from any base effects. In other words, last year was also very strong. We saw momentum continuing from Q1 to Q2 to Q3, and we do expect Q4 to moderate a little bit, but you'll end up with double-digit earnings even in 25. So that's a very strong setup, for example, compared to Europe, where earnings have been flat for 3 to 5 years, and there's expected to be some pickup from there, right? So the setup is very good. We do think that tech and the broad TMT space remains central to getting where we want to. To the extent that a space wobbles, we have a hard time seeing the market managing to push through without their leadership.
And when we talk about leadership or not, lack of leadership, your team recently did some work on single stock volatility, the individual moves we see in stocks, which tend to be then magnified even more during earnings season as we're seeing the reaction to earnings. But when we're seeing so many individual sort of idiosyncratic moves, what does an investor kind of do with that?
It's very interesting because one of the interesting things, and we expect that to continue this year, is like you noted that dispersion within single stocks of returns has been extremely high. The corollary to that is the fact that the correlation, whether it is between sectors or for stocks within sectors, or for stocks within S&P itself, is at historic lows. So in principle, this is an extremely good environment for stock picking and hence for active management. But the caveat is that returns still continue to be very concentrated. So if I look at the rolling 12-month returns, even now, or at least only 35% of stocks in S&P have done better than the index returns, right? So returns do get concentrated. If you look at the top 10 contributors to S&P returns last year, not surprisingly, 5 of the big tech 6 stocks are within those. So I think it's a very tricky market where, in principle, it is a stock picker's market, but navigating that is not going to be easy. And to your point, one of the points we noted was the volatility attributed to earnings has increased to the highest levels in a long, long time. So, and that's partly to do with the fact that information dissemination is moving very fast. So people are processing information, reacting, but that doesn't necessarily make an investor's life easier in navigating that. The last point I will make is that even big tech, on which we're very positive, which by the way is close to, call it 35% of the market and accounts for well over a quarter of S&P earnings, the correlation between those 6 stocks itself is hitting multi-year lows, right? So it was either ways to begin with in the 40 to 50% range in the past, call it a few years. Now we're in the 20 to 25% range. So if you can navigate even these 6 stocks, it can turn out to be great. But that's not to suggest that navigating and timing that is an easy task.
No, it doesn't seem like an easy task at all. I mean, and not only is it hard to perhaps look at the market from a macro perspective, sort of that quote unquote top-down perspective, but even applying sort of thematic lenses might be somewhat challenging. The growth versus value debate that has come back, or looking at certain sectors within the market because of that dispersion. Do you not want to buy the whole S&P 500 right now? You want to just go in and look at individual stocks?
Well, to the extent that you're confident in doing that, but it's going to be treacherous and tough. But owning the index is not a bad option at all. And I think, but if you look back, our own view is that we actually remain positive on fewer sectors, as opposed to buying everything,
Gotcha.
Right? So we continue to like tech broadly, and within that big tech even more. We like financials and we like utilities. But the underlying theme which continues to dominate the market is a broad AI theme. And our core conviction is that it'll sustain this year, even though the level of scrutiny around that has decidedly increased. So we are now in the 4th year of this AI cycle. And as some of these big hyperscalers are increasingly tapping the public and private credit markets, there's an extra pair of eyes in terms of scrutinizing what the underlying fundamentals are, what the balance sheet strength is. And the credit market itself is being very efficient in terms of pricing the risks across. So in other words, if you look at where the credit default swaps or spreads are of an Amazon or a Google, is very different than what it is for Meta, which is in the middle, as opposed to, let's say, an Oracle, which is another spectrum. So I think the market is sorting things out, but the theme is very much in place. AI adoption is expanding. The big hyperscalers are already monetizing AI to a substantial level in their own core businesses, and the use cases is expanding. That said, enterprise usage is still quite low. So I think the whole play now has entered a different phase of applications down the line for a wider adoption. But as we wait for that to unfold, I think tech, especially the big tech, and AI as a theme is the core of this market.
And it's interesting that you say that, because we were talking during the break about how we came back from our holiday breaks, rested, ready to go, and it has just been headline after headline, Truth Social post after Truth Social post coming from the president that have created some turmoil in the market. Is basically what you're saying, like AI is the more powerful force,
yeah,
and maybe try to disregard some of that headline risk?
Yeah, broadly speaking, I think the lesson from 25 is to ignore the policy-driven sort of chaos. And I think the message is broadly the same. The tricky part is every now and then, some of those policies are indeed translating into something very tangible. So what is the direction of that is important. And of course, this year is the midterm elections, so you can expect more, what should I say, policies more friendly towards sort of that process, but that has different implications. What does it mean for the deficits, which have been actually going in the right direction, but what does it then mean in the credit markets? Right now, the rates market, for example, is very benign. The 10-year is still sitting at 415. We are not in danger zone at all. Equities have done well. But to your point, though, the policy uncertainty is adding fuel to this dispersion we are talking about, where at the index level, things are relatively calm, including with the VIX, but at the single stock level, the volatility is very high. And if you look at each of these pronouncements, whether it is about credit card capping fees, whether it's about the ability of institutional investors to buy into the housing market, right, with the defense companies being able to buy back stocks or pay their in compensation, each of these has caused a lot of volatility in individual stocks for a brief period of time. And the question is, how realistic is it and how likely is it that it translates? So in the case of financial, for example, we remain very optimistic. I think valuations are decent, capital market activity is humming, M&A activity is likely to pick up, the yield curve has already steepened, I think it will remain steep, which is good for their fundamentals. So I think you have to have a thick skin and be able to look beyond the chaos while tactically navigating the market from time to time.
A lot of meditation on the part of desk traders this year, I think. Yeah. Thanks so much, Venu. Appreciate it.
You're welcome.
Well, coming up on Morning Brief, we'll bring you today's top trending tickers and count you down to the opening bell. We'll also talk more tech. Now time for some of today's trending tickers. We are watching BlackRock, Boston Scientific, and Spotify. First up is BlackRock. The stock is rising after the asset manager posted better than expected earnings in the fourth quarter. Profit did fall from a year ago. That was tied to one-time costs stemming from a string of acquisitions. Revenue was up more than 20%. A key metric for BlackRock is assets under management. It climbed to a new record above $14 trillion. Also, net inflows topped analyst expectations at $342 billion. Next up, Boston Scientific, the healthcare giant announcing it's acquiring Penumbra, a medical device company, for $14.5 billion in a cash and stock deal. Penumbra makes devices to treat conditions including strokes, heart attacks, and aneurysms. Those shares jumping roughly 13%, 12% ahead of the open. It's the first major deal in the healthcare space this year, and analysts expect it to be a busy one for M&A activity in the sector. This is Boston Scientific's largest acquisition in over 20 years. Finally, Spotify. That stock a bit higher after the audio streaming platform announced it is raising prices yet again. This round is focused on premium subscriptions in the U.S., the price tag going to $12.99 a month, up from $11.99, and the new pricing goes into effect in February. Spotify previously raised the price of this subscription in 2023 and in 2024. Well, Taiwan Semiconductor fueling AI optimism as the chipmaker reports fourth quarter results and guidance that topped estimates. Most notably, the company's better than expected capital expenditure forecast. Perhaps welcome news for the AI market. Baird Tech strategist Ted Mortonson is joining us to discuss. Ted, it's always great to see you. I was indeed struck by that CapEx forecast. I mean, everybody's raising their CapEx forecast, it seems. And so TSM kicking things off this year, $52 to $56 billion is what it's expecting. What did you take away from that and from the rest of the results?
Well, the CapEx is very interesting. It's up 32% for 2026, which is a huge number. And what that represents is really the core demand they're seeing. The cloud titans think that TSM is essentially the bottleneck for AI on chip manufacturing. So that CapEx number was above the street, and that's why all the semi-cap equipment names are rallying. But there were some other metrics coming out of the call that are equally important. TSM is going to grow at 36% versus the broader foundry index at, call it, 16%. The other thing is on the high performance compute side, which is 55% of their revenues. Think of that as just Gen AI. 18% of their total revenues are now Gen AI, and they can't meet demand. The last thing is this 2 nanometer node is the magical node from performance and power. They are at least a node and a half ahead as it relates to a technology advantage from any of their competition on the foundry side. So they've really got core dominance going on.
How should we be thinking about TSM in terms of what's going on between U.S. and Taiwan? Of course, we're working on a trade agreement with them, and I expect there's some expectations that they're going to be building more in the U.S., but how should investors be thinking about that?
It plays into the geopolitical that is not in this market. If you look at TSM's revenue, 74% of their revenue is going to the U.S., and they are accelerating their fab construction in Arizona. They're actually pulling it in pretty dramatically. They're investing $167 billion into the U.S., and that gives the U.S. a huge advantage, not only on AI, but also on defense capability. A lot of those defense silicon is done at the 5, 3, and 2 nanometer node in the future. So it's really providing a wedge between the U.S. And through our policies of the Trump administration, the U.S. and China. So again, U.S. is 74% of TSM's revenue. China's only 9% of TSM's revenue, and they're restricted on any of the leading node productions under 14 nanometers. So from an economic standpoint and a technology standpoint, it really favors the U.S. and quite frankly plays in the geopolitical argument.
Yeah, it definitely seems that way. I was struck on the broader AI note on a comment that the CEO, C.C. Wei, said on the call. He was asked something by an analyst, and he said, "You're trying to ask us whether AI demand is real or not. I'm also very nervous about it," he said. He talked about how much they were spending, and he said, "If we don't do it carefully, that'd be a big disaster for TSMC." This seemed pretty honest, right? That like they're worried about the same thing that everybody is asking questions about. But is it sort of, I mean, they are putting their money towards that, so they must have some high degree of confidence.
I think they've got visibility through the cloud titans out anywhere from a year to 2 years. And when you have that visibility and they're controlling the purse strings, if you look at Google, Microsoft, Meta, they can all support this CapEx through their existing businesses, and they're giving TSM visibility out that they have confidence on building out that CapEx and running these fabs at very, very high utilization. One thing that also came out on the call that I think is noteworthy is their gross margins came in at 62.3% versus 59% year over year. They are killing it as it relates to utilization and cost takeout. So they're really the key for the cloud titans on bringing this AI infrastructure to light.
Do you think that investors should own TSM itself? Do you own everything that sort of touches it? I mean, as we know, this is a very interconnected web within this new Gen AI build out. So how do you think about investing in it?
I think 25 was easy. 25, all boats lifted. I think 26 is going to be more volatile, and you really have to segment your buys. From the cloud titan perspective, we're trying to favor companies that have really, really good free cash flow, and again, that their core businesses support this CapEx, like a Google, Microsoft, a Meta. Apple, very controversial. They're behind as it relates to the AI trade. When you're asking another cloud titan to power Siri, that's Google, that rubs a fair amount of my clients the wrong way. As it relates to semi-cap equipment, there are roughly 3 plays if you want to do the bundle of ASML, AMAT, and Lam. And then from the semiconductor side, I think NVIDIA is obviously the biggest derivative coming out of this report. I think what people are missing on NVIDIA is their software dominance, their development of 3 to 5 years ahead of anybody in the eco chain. That's an overweight, in our humble opinion. And then there's some specialty semis that play on this infrastructure area that were cyclical that are now turning into secular plays. Like look at APH, Amphenol, or look at the entire optical group, whether it be Ciena, Coherent, Lumentum, even Cisco or Arista, that build out on the infrastructure side, as well as memory, obviously Micron, SanDisk, Samsung, and SK Hynix. Mm-hmm. We've got 2 years of unbelievable demand in front of us. So you've got to be very, very specific.
Very specific. So it seems like 26 might be harder than 25, but it seems like there's still a lot of opportunities. And thankfully for our viewers, you enumerated a number of them there. Ted, it's great to see you. We'll catch up again soon.
Okay, Julie, take care.
Thank you. Well, coming up next, we've got Opening Bid with our executive editor, Brian Sazzi. Saz, what's coming up on the show today?
Well, we're going to keep that theme going on TSMC. What does it mean to the Mag 7 trade? What doesn't it mean? Also, like those investment banking results from Goldman Sachs and Morgan Stanley. And then, Julie, my stock of the day is Salesforce. Stock down 10% year to date. Not a good year so far for Mark Benioff and co.
Yeah, more of a slog for them and other software stocks for that matter. Looking forward to that chat. That does it for Morning Brief. Thanks, Oz. You got much more ahead on Yahoo Finance Opening Bid next.